There is a single number set by a small group of unelected officials that controls the cost of your mortgage, the return on your savings, the interest on your credit card, and the value of your investments, all at the same time. Most people have heard of it. Almost nobody understands how it actually works. And when it moves, which it has done dramatically in recent years, it can cost you or save you tens of thousands of dollars without you doing anything at all. Today, in the next 20 minutes, I'm going to show you exactly what that number is, exactly how it works, and exactly what to do when it rises. Stay with me, because Section 4 is the one most people get completely wrong, and it costs them the most. Welcome to Money Explained in Minutes, where complicated money becomes simple truth in under 20 minutes. By the end of today, you will understand exactly what interest rates are, why central banks move them, and what every rate change means for your mortgage, your savings, your debt, and your investments. Let us get into it. Let us start with what an interest rate actually is, because the word gets used in so many different contexts that most people have a blurry understanding of it rather than a precise one. An interest rate is simply the cost of borrowing money, expressed as a percentage of the amount borrowed, charged per year. When you borrow $1,000 at 10% interest per year, the cost of that borrowing is $100 per year. That is it. At its most fundamental level, the lender charges you for the use of their money. The interest rate is the price of that use. But here is where it gets important. There is not just one interest rate. There are thousands of interest rates operating simultaneously. The rate on your mortgage, the rate on your credit card, the rate on your savings account, the rate on business loans, the rate on government bonds. All of these are different, but they are all influenced, sometimes dramatically, by one master rate, the rate set by your country's central bank. In the United States, that is the Federal Reserve. In the United Kingdom, it is the Bank of England. In the Eurozone, it is the European Central Bank. This master rate is called the base rate or the federal funds rate, depending on where you are. And when it moves, every other rate in the economy tends to move with it. Think of the base rate as the wholesale price of money. When banks want to borrow money from the central bank, which they do constantly to fund their operations, they pay the base rate. When they then lend that money to you for a mortgage or a car loan or a credit card, they add their own margin on top. So if the base rate is 5% and the bank adds 2%, your mortgage rate is roughly 7%. When the base rate rises, the wholesale cost of money rises, and banks pass that cost on to every borrower in the economy. So why do central banks raise interest rates at all? The primary reason is to fight inflation. Remember from last week, inflation is what happens when too much money is chasing too few goods and services, causing prices to rise. When central banks raise interest rates, they make borrowing more expensive. More expensive borrowing means people and businesses borrow less. Less borrowing means less money flowing through the economy. Less money flowing means less demand for goods and services. Less demand means prices stop rising as fast. That is the mechanism. Higher rates slow the economy down intentionally to bring inflation back under control. But here is the problem. That same mechanism that slows inflation also slows everything else. When rates rise, mortgages get more expensive. Businesses find it harder to borrow to expand. People with variable rate debt pay more every month. Consumer spending falls. Job creation slows. In the worst case, the economy tips into recession. This is why central banks describe setting interest rates as walking a tightrope. Rates too low, inflation spirals. Rates too high, economy crashes. The goal is always to find the rate that keeps inflation under control without destroying growth. Here is the data that shows just how dramatically rates have moved in recent years. In 2020 and 2021, central banks around the world cut rates to near zero to support economies through the pandemic. The US Federal Reserve held rates at effectively 0.1% for nearly 2 years. Then, inflation hit, and between March 2022 and July 2023, the Federal Reserve raised rates 11 times from near zero to 5.5%. That is the fastest and most aggressive rate-rising cycle in 40 years. If you have a mortgage, savings, investments, or any debt, that cycle affected every single one of them. Now, let us talk about what rising interest rates actually do to the 4 things that matter most in your personal finances, starting with mortgages. Because for most people, this is where rising rates hit hardest and fastest. If you have a fixed-rate mortgage, rising rates do not immediately affect you. Your rate is locked in for the term of your fix. But when that fix ends and you need to remortgage, you will be remortgaging onto the new, higher rates. And the difference can be significant. Someone who fixed at 2% in 2021 and remortgaged in 2023 at 5.5% on a $300,000 mortgage saw their monthly payment rise by over $1,000 per month. If you have a variable rate mortgage, rising rates affect you immediately. Every time the central bank raises rates, your monthly payment goes up. There is no protection, no delay, no buffer. The rate rise happens, your lender adjusts, and your next payment is higher. This is why the rate cycle of 2022 to 2023 created genuine financial hardship for millions of variable rate mortgage holders. People who had planned their monthly budgets around much lower payments suddenly found themselves paying hundreds of dollars more per month, with no warning and no choice. What should you do about your mortgage when rates are rising? There are 3 clear actions. First, if you are on a variable rate and rates are rising, explore fixing your rate as soon as possible to provide certainty. Second, if your fix is ending in the next 6 to 12 months, start remortgaging conversations now. Early applications can lock in current rates before further rises. Third, do not panic sell your home to escape a higher mortgage. In most cases, the cost of selling, renting, and rebuying exceeds the cost of the higher rate unless your situation is extreme. Now, here is the section most people get completely wrong. And it is the one that either costs them or rewards them the most depending on what they do. Rising interest rates are actually good for savers. When the base rate rises, savings account rates typically rise too. In 2020, when rates were near zero, savings accounts paid almost nothing, often 0.1% or less. By 2023, when rates had risen to 5.5%, easy access savings accounts were paying 4 to 5%. That is an enormous difference in the real return on your cash. Someone with $50,000 in savings earning 0.1% was making $50 per year. At 5%, they were making $2,500 per year. Same money. 50 times more return. But, and this is where most people go wrong, most people do not automatically get the higher rate. Banks are very fast at passing rate rises on to borrowers and very slow at passing them on to savers. Research consistently shows that when the base rate rises by 1%, the average variable rate mortgage rises by close to 1% within weeks. But the average savings account rises by only a fraction of that, often as little as 0.1 or 0.2%. The banks keep the difference. This means you have to actively move your money to get the benefit of rising rates on your savings. The default option, leaving your money where it is, almost always means you are being significantly underpaid. What should you do about your savings when rates are rising? 3 clear actions. First, check what your current savings account is actually paying. Open your banking app right now and find the interest rate. Most people do not know this number. Second, compare that rate to the highest available easy access savings rate in your country. In most cases, there is a significant gap. Third, move your excess cash, anything above your emergency fund minimum, to the highest paying account you can access. This single action on a $50,000 balance at a 4% difference is worth $2,000 per year. It takes 20 minutes. We touched on this in the last section, but let us go deeper because the interaction between rising rates and consumer debt is one of the most financially damaging forces most people face. When interest rates rise, the cost of every piece of variable rate debt you carry rises with it. Credit cards, personal loans with variable rates, overdrafts, lines of credit. All of these become more expensive every time the central bank moves. And here is the number that makes this real. The average credit card interest rate in the United States in 2024 was 21%. When base rates were near zero, that was already extremely high. But as base rates rose, many credit card rates climbed even higher, some above 28%. On a $5,000 balance at 28%, you are paying $1,400 per year just in interest before paying down a single dollar of the principal. The minimum payment trap becomes even more dangerous when rates rise. When rates were low, minimum payments on credit cards were at least making small inroads into the principal. When rates are high, minimum payments often barely cover the interest, meaning the balance barely moves or even grows despite payments being made every month. This is the mathematical trap that rising rates set for anyone carrying consumer debt, and the longer someone stays in it, the more expensive it becomes, because the interest compounds on an unchanged or growing balance. What should you do about your debt when rates are rising? 3 clear actions. First, list every piece of variable rate debt you carry with its current interest rate. Write it down. Second, prioritize paying down the highest interest rate debt as aggressively as possible. Every dollar paid down at 28% gives you a guaranteed 28% return, better than almost any investment. Third, explore consolidating high-rate variable debt into a lower fixed rate if your credit score allows. Locking in a lower fixed rate removes the risk of further rises. The relationship between interest rates and investments is where things get most complex and most misunderstood. Let us break it down clearly. Rising interest rates typically put downward pressure on stock market valuations. Here is why. When rates rise, bonds, which are government or corporate loans that pay a fixed interest rate, become more attractive relative to stocks. If a government bond is now paying 5% risk-free, investors require higher returns from stocks to justify the extra risk. To deliver higher returns, stock prices need to fall, which makes them better value relative to the now higher bond yields. This is the mechanical reason why stock markets often fall when interest rates rise sharply. But here is what long-term investors need to understand. The short-term pain of rising rates, falling stock prices, creates long-term opportunity. When stock prices fall, the same investment buys more units. If you are contributing regularly to an index fund or pension, rising rate environments where markets fall are actually buying opportunities. You are accumulating more units at lower prices. The investors who panic sell during rate-driven market falls lock in their losses. The investors who continue contributing steadily accumulate units that recover and grow when rate cycles reverse. Property values are also affected by rising rates. Higher mortgage rates reduce how much buyers can afford to borrow, which reduces the pool of buyers, which puts downward pressure on property prices. This played out clearly between 2022 and 2024 in many markets where property prices fell or stalled after years of growth as rates rose. The inverse is also true. When rates eventually fall, borrowing becomes cheaper, buyer demand returns, and property values tend to rise. Understanding this cycle allows you to make better timed decisions about property, both as a home and as an investment. Let us be direct about who benefits and who suffers when interest rates rise, because understanding this changes how you position yourself. The winners from rising rates are cash savers who move their money to high-yield accounts, people with no consumer debt, fixed-rate borrowers who locked in before rates rose, and retirees or near retirees who hold bonds or fixed-income assets that now pay more. The losers from rising rates are variable rate mortgage holders, people carrying credit card debt or variable loans, businesses that borrowed heavily at low rates and now face higher refinancing costs, and growth stocks and speculative assets that were valued on assumptions of cheap money forever. The most important insight from this list is that your position on it is not fixed. It is a choice. You can move from the losers column to the winners column by eliminating variable rate debt, moving cash to high-yield accounts, and locking in fixed rates where possible. The people who suffer most from rising rates are the people who took no action when rates were rising. The people who benefited most are the ones who understood the mechanism and repositioned accordingly. That repositioning does not require expertise or large amounts of money. It requires the understanding you now have and a few specific actions. Here is your 5-step interest rate action plan. This week, zero cost. Works at any income level in any country. Step 1. Find out what rate environment you are currently in. Is your central bank raising, holding, or cutting rates right now? This single piece of information tells you whether to prioritize fixing rates, moving savings, or paying down debt most aggressively. Step 2. Check every piece of variable rate debt you carry. List each one with its current rate. Rank them highest to lowest. Begin overpaying the highest rate debt this month, even by a small amount. Step 3. Check what your savings accounts are currently paying. Open the app. Find the number, compare it to the best available rate in your country. If the gap is more than 1%, which it almost certainly is, move your excess cash above your emergency fund to the better paying account. This action, on a $30,000 balance at a 2% rate difference, is worth $600 per year for 20 minutes of work. Step 4. If you have a mortgage coming off a fixed rate in the next 12 months, start the remortgaging process now. Early engagement with your lender or a broker locks in rates before further changes and gives you time to choose properly rather than under deadline pressure. Step 5. Review your investment contributions and do not reduce them during rate-driven market falls. This is the single most common and most costly mistake investors make during rising rate environments. They see markets fall as rates rise, they feel anxiety, and they reduce or pause their contributions at exactly the moment when they should be maintaining or increasing them. Every unit you buy during a rate-driven market fall is a unit you acquire at a discount that will recover when the rate cycle reverses. Keep contributing. Stay the course. The rate cycle always reverses. 5 steps, all free, all starting today. Step 1, find your rate environment. Step 2, list and attack variable rate debt highest first. Step 3, move excess cash to the best paying savings account. Step 4, start remortgaging conversations if your fix ends in 12 months. Step 5, keep investing through rate-driven falls. This is your interest rate protection system. Let us bring everything together. Section 1. What interest rates are. The cost of borrowing money set at a wholesale level by central banks and passed through to every loan, mortgage, savings account, and investment in the economy. Section 2. Why central banks raise them. To slow inflation by making borrowing more expensive and reducing the money flowing through the economy. Section 3. What they do to your mortgage. Fixed rate holders are protected until their fix ends. Variable rate holders feel every rise immediately. Section 4. what they do to your savings. Rising rates are good for savers, but only if you actively move your money to accounts paying the higher rates. Section 5. What they do to your debt. Variable rate debt becomes more expensive with every rise. Paying it down delivers guaranteed returns equal to the interest rate. Section 6. What they do to your investments. Short-term pressure on stock prices. Long-term opportunity for those who keep contributing. Section 7. Who wins and who loses. Your position is not fixed. It is a choice made by the actions you take or do not take. You now understand something most people who carry a mortgage, hold savings, and invest in markets never fully understand. Interest rates are not something that happens to other people or in abstract economic reports. They are the price of money. And when that price changes, it changes the value of everything you own, everything you owe, and every pound or dollar you earn. The moment this video ends, do one thing. Find out what your savings account is actually paying right now. Open the app. Find the number. Because you cannot fix what you cannot see. And if the number is less than the current base rate in your country, which it almost certainly is, you now know exactly what to do about it. If this gave you value, subscribe to Money Explained in Minutes. Every week, one important money concept made as simple as possible. No jargon, no lectures, just clarity. Drop a comment below. Has a rate rise ever caught you off guard? I read every single one. Next week, we are continuing the series. We are going to look at compound interest, exactly how it builds extraordinary wealth over time, and exactly how it destroys people who carry debt. The same force. Two completely different outcomes. Subscribe so you do not miss it. Money Explained in Minutes. Understand money, build wealth. See you next week.